which is the first of the next 6 chapters. So coming to the role of portfolio managers. Now, in terms of the importance of PMS, everybody knows that the regulations, the SEBI regulations for mutual funds came in 1996. And I'm sure you will be very happy to know that the PMS regulations started in 1993. So much before the regulations for mutual funds came in place, SEBI was focusing on PMSs. So you can understand the importance that SEBI has given to PMS as a product. Ultimately, in a PMS, it's a fund manager who will be playing an important role, a pivotal role in terms of managing the money for investors. If you look at the current regulations, ultimately SEBI is in control of it, and these are the 2020 SEBI regulations for PMS, which control all the PMSs. And any portfolio manager who want to offer PMS services in the current scenario will have to register himself with SEBI. So that's on the overview in terms of what is the criticality of PMS from the SEBI perspective and how important as a product it is for SEBI. Now coming to the differentiation or the types of PMSs that you can categorize into. I mean, you can do it basically basis 3 different categories. The one is basis the provider. Now, everybody knows that we are a part of the asset management company. So PMSs are offered by asset management company. So that's one of the categorizations from a provider perspective. The second is PMSs which are offered by broking houses. And the third is those boutique independent PMS houses which offer PMS. The second way of categorizing PMSs is basis the underlying product that a PMS is investing into. So you can have equity-based PMSs, fixed income-based PMSs, commodity PMSs, mutual fund PMSs. I mean, we also have a mutual fund PMS, a Pioneer, as well as a multi-asset-based PMSs. And the third and the most generically used category of PMSs, typically how people categorize PMSs basis the type of services that are provided by the provider. Which are classified as discretionary services, non-discretionary services, and advisory services. I'll come in detail, a little detail on that. So as I said, discretionary services are basically where the entire discretion with respect to managing the money of an investor is with the fund manager. So the fund manager is a person who will decide in terms of what to buy, when to buy, in what quantity to buy, when to sell, how much to sell, what to replace it with. So he is a person who will decide on whether he wants to buy a particular stock or not. So advisory is something which he is controlling. The decision maker is also him, wherein he will take the decision of what to execute, and the execution is also done by the fund manager. So all three with respect to advising, decision making, and execution is something which is controlled by the fund manager, and hence it is at a complete discretion of the fund manager. The second type is the non-discretionary services. Now, in this, what happens is the advisory is still by the fund manager. The decision, which earlier in the discretionary was with the fund manager, your discretion is, or the decision is of the investor. So ultimately, basis the overall strategy that has been decided between the investor and the fund manager, or the agreement or the contract between the investor and the fund manager will identify opportunities. But whether to execute that trade, the decision to buy or sell or trim is something that is taken by the investor. So investor's consent is required in this particular scenario. The execution part, the third part, is still controlled by the fund manager. So unlike this discretionary, here only the decision making goes to the investor, while the advisory as well as the execution remains with the fund manager. The third type of PMS services that are available in the market is basis the advisory services. Now, in this, again, basis the contract with the investor, the advice is given by the fund manager. But here, along with the decision making, the execution is also done by the investor. So that's a basic differentiation between these three categories. With respect to the PMS, as I said, the fund manager or the portfolio manager is the central part of the service. The portfolio manager is basically a corporate body which, according to a contract or an agreement with a client, will advise or direct or undertake basis what type of PMS is getting executed on behalf of the client. They will do the entire administration and management of the portfolio of whatever the underlying asset class is decided. A body corporate is a new word. So just going a little deeper into it, a body corporate is basically any legal entity, which can be a private company, it can be a public company, it can be a single persona company, a small company, an LLP. So anybody who is a registered company and a legal entity is somebody who can become a body corporate. Who is it that cannot become a body corporate? So a cooperative society which is registered under cooperative law cannot be, and any other corporate body which the central government may notify. So primarily any cooperative society. So this can be one of the questions with respect to who can be a body corporate. And if there are multiple options, just remember that a cooperative society, which is registered under the cooperative law, is somebody that cannot run a PMS. Rest anybody who has a legal entity can run a PMS. For the registration of the fund manager, firstly, for anybody to offer these services, he needs to register with SEBI, which is a mandatory requirement and which happens with a non-refundable fee. And for that, he needs to fill the Form A under Schedule 1, and which typically captures the basic details of the applicant with respect to particulars of the applicant, which is basically the name of the entity, the PAN number, the address of the registered office or the correspondence address. Along with that, the format also captures the organization structure. So overall, the organization chart, who are the directors, who are the partners, who are the key management personnel, the details or the particulars of the promoters, who is the compliance officer. So all these details will get captured as a part of the organizational structure. Then the fund manager or the portfolio manager also has to give in the details of the infrastructural facilities with respect to what type of facilities they have in terms of the office equipment, where the office is located, what are the fixtures and furnitures that will be utilized, what will be the hardwares and softwares that will be utilized with respect to the execution of the PMSs. The company, the person who is wanting to register also will have to give a business plan for the next 3 years. So he will have to basically project with respect to how he plans to grow his PMS, as well as what will be the ways of achieving that objective. So the business plan needs to be a part of that format. Financial information, which is the current financial information of the company, typically for the current year and the preceding 2 years. So 3 years financial information is something that is required to be given, which includes a capital structure, the net worth of the applicant, what are the major sources of income, what has been the net profit of the company. So all that financial information is captured. Any other information with respect to any disputes that have been settled, or what are the pending disputes, any indictment with respect to involvement in any of the economic offenses. So all that information also needs to be given under the other information tab. The applicant will also need to give the business information with respect to what are the facilities that the fund manager will be utilizing to make decisions on portfolio investment, what will be the grievance redressal and dispute resolution mechanism, what will be the risk profiling procedure, who all will be registered primarily as the brokers for execution of trades, what sort of databases will be utilized for research for the underlying investments in the PMS, and in case of any outsourcing, even those details need to be mentioned in the Form A. So along with that, experience of the fund manager or basically of the company that is wanting to get a license as a PMS provider. So basically details of what that company is currently doing or what services they are currently rendering. Any additional information with respect to what will be the draft agreement between the client and the fund manager, or the disclosure document that will be filed with SEBI with respect to what will be the products that a company could offer in times to come. It also includes the details of the custodian as well as the details of registration with other regulatory bodies. As I said, it's a corporate body, so it's a legal entity. So details of that will be captured primarily in the additional information tab. Then there are a host of declarations that are required with respect to, I mean, SEBI requires that a fund manager or the PMS provider needs to be a fit and a proper person. It can't be a arbitrary person. So it should be a fit and a proper person. Then what will be the fees and charges that will be applicable on the PMSs, a declaration from that perspective in terms of the compliance of these fees. Then what will be the frequency with which reports will be sent to investors. So all these declarations will also need to be inputted. Before issuing a registration certificate, the regulator will basically ensure, depending upon whatever I said in the previous slide, that one, it is a body corporate. Secondly, it has the necessary infrastructure and manpower to provide the services, so that there is no issue after the registration is done. Has appointed a compliance officer, which is a very critical aspect from a SEBI perspective. Has a principal officer who is basically responsible for all actions of the fund manager. So principal officer is basically the person which is one level above or which governs all the actions or responsible for all the actions of the fund manager. Then there are requirements with respect to the minimum qualification that the principal officer should have. So the experience requirement is 5 years in related activities. Again, something that could form a part of the questions. So at least a 5-year related work experience is required for a principal officer. Along with that, it also, so along with the principal officer and the compliance officer, the entity should have at least one more person which has at least a 2 year of experience in a related industry and who has a graduation degree from a university or a recognized institution by the government. Also, the SEBI will ensure that there has not been any disciplinary action against the person who are directly involved with respect to the management of the PMS. Just to continue on that front, there is also a net worth requirement. Again, something that could form a part of the question. There's a net worth requirement of 5 crore rupees for an entity to register as a PMS provider. Then the person who is applying or the entity which is applying should not be involved in any litigation connected with the securities market, and which basically has had an advanced bearing on the business of the applicant. He should not, or the entity should not have been convicted for any offense involving moral turpitude or has been found guilty of any economic offense. As I said, SEBI warns that ultimately the person behind that legal entity needs to be a fit and a proper person. Also, ultimately the grant of certificate is looking at the interest of the investors. A few of the do's, again, which will little overlap with the earlier 2-3 slides. So from a do's perspective, the fund manager is expected, or the portfolio manager is expected to take adequate steps for redressal of grievances of investors within 1 month. So the timeline is something that you may require to remember from an examination perspective. So the grievance redressal has to be within 1 month from the date of receipt of this complaint, and the portfolio manager will have to keep on updating SEBI with respect to all these complaints that are being received by the portfolio manager. The portfolio manager needs to abide by the code of conduct. He should ensure that he segregates each client's holdings in securities in each client's holdings in separate accounts. Ultimately, everybody knows PMS is an agreement wherein all the transactions happens in the name of the investor. The fund manager is only responsible to execute the trade, and that's why we take a POA from the investors to transact on his behalf in his demat account. So stocks always remain in the demat account of the investor. The fund manager or the portfolio manager is also responsible to keep the funds of all clients in a separate account maintained by it, It can be a pool account for all investors together. It can be separate bank accounts for individual investors, but there has to be a separate account. It shouldn't be like all the funds are taken in the bank account of the company itself or the PMS provider itself. So separate bank account is required for that particular investment approach. I'll come to what investment approach is. Transact in securities within the limitation placed by the client himself, which basically means that abiding by the contract. So whatever has been the contract between the investor and the fund manager, the portfolio manager has to ensure that whatever securities he are dealing in and he's executing in the portfolio has to be within that guidelines. As I said, segregate each client's funds and portfolio of securities and keep them separate from his own funds. I already mentioned that in the previous point, but he has to segregate and keep all the securities and money in a separate account, not into his own account or his entity's account. And he's responsible for safekeeping of records of these accounts. A few of the don'ts from the portfolio manager's perspective. The portfolio manager should not derive any direct or indirect benefit out of the client's funds or securities. They are not allowed to borrow funds or securities on behalf of the client, must not lend securities held on behalf of the client to a third person. The money or securities accepted by the fund manager or portfolio manager shall not be invested or managed by the portfolio manager except in terms of the agreement between the portfolio manager and the client. We saw a similar line in the do's, which is they should follow the agreement. While investing in units of mutual funds through direct plan, the PMS provider shall not charge any distribution related fees. Not to leverage on the portfolio of its clients or investors and derivatives. Continuing with the don'ts, should not deploy clients' funds and bill discounting, badla, or for the purpose of lending or placement with corporate or non-corporate bodies. Must not invest a client's funds in the portfolio managed or administered by another portfolio manager. So ideally, I or we being PMS providers, we can't in turn invest into, say, some other company's PMS portfolio. Should not invest clients' funds based on the advice of any other entity. So I can't even take advice of, let's say, any other PMS provider and then build portfolio. So earlier, multi-manager funds were in existence, but now that is not allowed basis the regulations of 2020. While dealing with clients' funds, should not indulge in speculation, cannot keep any open position in respect of allocation of sales or purchases effected in the day. So all settlements need to happen on that day end. You can't keep any position open. Must not hold securities belonging to the portfolio account in his own name or on behalf of its clients, either by virtue of contracts with clients or otherwise. In terms of the administration or the execution of the PMS strategies, it can be in two ways. One, I mean, I'm sure everybody is aware of that, because when we open PMS accounts, either the account is a pool account where the bank account is not opened, or it's a non-pool account where the separate bank account is opened. In pool execution, what happens is, since everyone's money is pooled in one account and from that account the securities are bought, then the allocation to individual securities has to be done. So trading for all clients is together, and then allocating individual securities to each client's demat account is required. While if that execution happens at an individual client's name, trading in individual client's name, then all allocation happens automatically. So these are the two ways of execution or administration of investors' portfolio. The portfolio manager is not allowed to execute any off-market transactions, except if there's a, let's say, a closure of the client's portfolio, and hence you want to transfer his securities from our demat to his demat. In that time, it's a close and transfer, and where the off-market transaction happens. But otherwise, off-market transactions are not allowed for PMS providers. Also not allowed even if it is for providing margin or collateral for clients' own positions. I mean, except it is allowed if it is for providing margin and collateral for clients' own positions, for dealing in unlisted securities, because that's typically done only off-market. And all this requires specific consent of the client for each transaction and any other reason as specified by SEBI from time to time. The agreement between the portfolio manager and client is basically what is governed by what we call as the investment approach. Everybody knows we have 5 investment approaches: the Kotak India Focus Portfolio Investment Approach, or the Kotak Small and Mid Cap Equity Investment Approach. So all these are investment approaches. An investment approach is basically taking into account factors specific to clients and securities. Areas, it basically determines the areas of investment and restrictions, if any, imposed by the client with regard to the investment in a particular company or industry. Thus, the universe of securities for the purpose of investment is well defined in the agreement. The agreement between the portfolio manager and the client should include the terms of early withdrawal of funds or securities by the client. Exit loads are from a withdrawal of money perspective, but any other terms in terms of early withdrawal needs to be mentioned. Exit loads can be applied, but lock-ins are not allowed by PMS providers. As I said, it should include the withdrawal fees in terms of the percentage, and SEBI has put a capping with respect to how much you can charge from an exit load perspective. I will come to it, but withdrawal fees is something that needs to be mentioned in that agreement. And portfolio managers can, as I said, cannot impose a lock-in on the investment of their investors. Under the SEBI circular of 2020, February 13 circular, exit loads are capped at 3% in the first year, 2% in the second year, and 1% in the third year. There cannot be any exit loads post 3 years. This is not a regulation for AIF. AIF is still allowed to have an exit load after 4 years. So just ensure that this is specifically for PMS. Maintenance of records, something which is a responsibility of the portfolio manager. The portfolio manager needs to keep and maintain the book of accounts, records, and documents. The principal officer of the portfolio manager is in charge of keeping the records. After the end of each accounting period, these needs to be furnished to SEBI. Copies of balance sheets, profit and loss account, and any other such documents that is required by SEBI. You need to, as a portfolio manager, we need to preserve records for the last 5 years and furnish them to SEBI in case if they ask for it. The portfolio manager's accounts shall be audited annually by an independent chartered accountant, and a copy of the certificate issued by the accountant shall be given to the client. Everybody knows we give audited capital gain loss statement for investors. So basically, these are the audited reports that is required by an independent chartered accountant. The books of accounts will be audited yearly by qualified auditor to ensure that a portfolio manager has followed proper accounting methods and procedures, and that a portfolio manager has performed his duties in accordance with the law. To ensure that all this is in place, the appointment of compliance officer is very, very critical, because ultimately he's the one who is responsible for complying to all the regulations that are set by SEBI. So every portfolio manager shall appoint a compliance officer who shall be responsible for monitoring the compliance of the act, the rules and regulations, the notifications, the guidelines, the instructions issued by SEBI or central government, and for the redressal of investors' grievances. So compliance officer becomes a pivotal person with respect to any of the to ensure that a portfolio manager is abiding to the entire act and the rules as prescribed by SEBI. The compliance officer shall immediately and independently report to SEBI on any non-compliance observed.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.